analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Good afternoon, folks. I'm Dan Gibby here with my partner, as always, Greg Capra. We have an amazing educational session for you today. We've been doing this over 5 years, and we pick a particular topic and we delve into it as much as we can in the 1 hour allotted time. We save time for questions, for market review. And today we're going to show you the benefits of trading options, both buying them using the master trader approach and selling them. We actually did a specialized session on selling options just a couple weeks ago. You can check out that recording. And we're going to have an additional little emphasis today because a lot of people come to the marketplace, they have a passion for it like we all do. And they're like, you know what, I don't have a big account size. I would, and I love the benefits of options, which you're going to learn today. And they say, well, can you help me intelligently use my small account? Today's session, we're going to assume you only have $5,000 in your account. You want to objectively learn how to trade options, both long and short. And you don't want to have this gambling mentality. And that's what we're focusing on today. So sit back, get ready to get empowered with some great information. And as always, we can answer questions here. Well, we can answer questions throughout, of course, but we dedicate time to look at the charts in real time and see if we can find some opportunity to trade today. So yeah, welcome, Greg. This is our slide we show all the time. Say hello there, Greg.
How you doing, everybody?
And Greg, you know, you usually do the intros, but I wanted to do it today since this is my passion. And I just wanted to share one story of our history of why this is my passion. So you know, we've been working together over 3 years. And I learned so much of technical analysis with you, but I've also been trading options that's longer than that. I've been trading options since the old Wade Cook days where I had no idea what I was doing. And then I would say like our magic together was using the technical approach to trading options intelligently. And that's what we'll be sharing with you as much as we can today. So
I don't know how anybody, well, I kind of know how they do it without technicals, but it's just such a, I don't know, like fighting with one hand behind your back, not to be able to look at the chart along with the options data.
Absolutely. So that's why we're starting with this. This is our approach to trading anything that moves. Start with a technical pattern. Now, an option is just a derivative of the underlying. And so if we don't have a bias of what the underlying is doing, the underlying meaning the stock, the ETF, the cryptocurrency, the future commodity, whatever, then as Greg just said, then you got, one hand tied behind your back. So I need everything we do starts with a compelling pattern. Tell me what your bias is. Then we take that picture of a compelling setup. We add the other concepts that make up our approach. Where is this picture in the trend, multiple time frames? Is it showing relative strength or weakness? What are the broader markets doing? Last Wednesday's MT Live, we focused on our techno fundamental approach, and of whether we are looking at a year-end rally, and Greg talked about a lot of what he does in his detailed market review on the weekend. So that's another fantastic session you should check out. So I guess a couple definitions here to get us started, particularly for the new people. So you want to buy a call or a put. I got a $5,000 account. All right, I buy a call, and what does that call option give me? It gives me the right to buy the underlying. Well, Dan, I don't want to buy the underlying. I only have a $5,000 account. Don't worry about it. It's giving you the right to buy it at a certain price at an agreed upon expiration. So in a small account, excuse me, we are buying these call options when we have a directional bias. So if we're bullish on Apple or Cisco or Bank of America, and we're using our technical approach, yep, this is a place I'd buy the stock, but I want to buy a call option instead. The benefits are leverage and limited risk, and I want to grow my small account intelligently. I have a compelling pattern. I'm going to show you as many examples as I can of how you're going to profit from this directional bias by buying a call option, because that call option is going to go up in value as the underlying stock goes up in price. That's how we profit. The put is the identical on the reverse. In fact, as you know, Greg, we just sent out the trade review of the week this morning, every Wednesday, and we did 5 bearish directional trades in this particular trade review. Some involved buying puts. So we're profiting as our bearish pattern falls as anticipated. That put goes up in value. We're also, even though a couple of weeks ago we had a separate MT live on selling options, particularly short dated ones. And I'll give you 1 or 2 examples here today, with the chart, of course. And we're just profiting when we're taking the other side of the bet of the option buyer or seller. Remember, Greg said a few moments ago, how can you trade options without a bias? And so people buy calls and puts for whatever reason. And if we look at the chart pattern saying, well, that's a stupid place to buy a call, that's a stupid place to buy a put, then we have strategies to profit by selling those options to those people. And so we can do it naked or credit spread, but I have an example, so let's wait on that. All right, so here, Greg, you actually found me this. So why don't you, just give your personal opinion of objective trading. You said it this morning in our pre-market trade review. You said, we at Master Trader have an objective method.
Yeah.
Interpreting it.
So you probably wonder why I said that, Dan, but when I was talking about our discussion in the green room and as to, hey, we think the markets are at a short-term turning point, which was part of the pre-market discussion today, and there's going to be choppy price action and so on and so forth. And I mentioned the discussion of us saying, hey, maybe it makes a new low or maybe it doesn't. Mm-hmm. And someone new on the social media account there said, are you saying we're going to make new lows? And I was like, no, it was part of the discussion. And what I said was, we don't make predictions like that. We have our method of determining where we are at and what the likelihood is of things changing in this moment, either bullish or bearish. And then where it goes from there, we continue to we get our bias. Like you said, here, there was all these, and I dropped the link of the trade review. Here's 5 bearish things. And why? Well, because with the location where things were and the patterns, and that's the objective method of coming to some bias. And I think I say I think, but I actually know because I've been doing this for 30 years. So I think why most people get hung up on technical analysis is everybody's looking for the ultimate, holy grail. Hey, it'll never fail. I'm going to be right 100% of the time. God forbid I'm going to lose any money. That shouldn't happen. And the markets don't work that way. So and it's what options are about. We're probability people, whether it's options or just placing a long or a short trade. It's like the probability of prices moving up, down, or sideways is based on that first slide.
So, this bottom right here, Greg found it in some email and I liked it. So I took a little screenshot here for you. Folks, this is Dan talking. If you ever see any advertisement in any aspect of your life, don't exercise, eat whatever you want, take my magical pill, trade now, win money, fast, easy money. My recommendation is to delete it, to run, because it's they're full of it. And Greg, I used to get so irritated when I would see this. And then now, maybe I'm getting older. It's like, you know what? If you're this stupid to believe it, then have a good time. Maybe you two are meant for each other. That is not us. We have an objective, successful approach. We do not go for the home run, but we do have in what we call an intelligent home run that's based on objective information. It's not a lottery ticket. The people who have a small account in particular, unfortunately, who don't have the money to lose, we see so many of them come into this business with a gambling mentality, trying, and a lot of this happened over the COVID times. Greg, I used to see all kinds of self-proclaimed rich option traders who are now driving golf carts in my neighborhood because they blew up their account. They got lucky on a couple of trades. They think they're famous. They think they're smart, and they're not smart. They're going to blow up their account.
I thought you were going to say they hit the home run and now they're playing golf, retired.
Well, some might, of course. We got the bell curve, so some over here might have done it with Bitcoin on a levered instrument, whatever the case. So sure, there's exceptions to everything. All right, let's continue here. We have wonderful information. So I put this kind of case study together, and it's 5 slides. We're going to march through it slowly. And then I got a bunch of slides we're going to go through fast, as much time as we have, because you'll see once you understand, it's going to be like, rinse and repeat. Yeah, I get it. I'm excited. I'm going to join your trading room and an advisory letter, because I now see the 2 guys behind the curtain of what they're doing when they send me a Telegram alert. I see what goes on behind the screen. So here we go. Step 1, we're going to buy puts. Remember, I told you on slide number 2, everything starts with a pattern. So this isn't an uptrend. We buy bottoming patterns for a bounce into a downtrend. This actually is profiting with a setup just for a counter trend retracement and an uptrend. We're traders. So we define swing trading as, 2 to 10 day holding period. So everything starts with a pattern. What's this pattern? Well, it's extended, had a big old run. It's at the 200, breakout failure, small M top, and a bearish 1, 2, 3. And another concept we have is what's called the price void. So look to the left. Because of this momentum move up, it has room to retrace. Okay, so check. I got a bearish pattern for a short-term swing trade. IWM, the Russell 2000 ETF. So set up, enter, manage in between. And, we're going to get into, okay, well, what do I do now, Dan? Well, sit tight. And I have this statement here that all directional set, and we define directional as I'm willing to buy or sell the underlying as a swing trade. Okay. And I say, okay, well, then that qualifies for a credit spread, an income trade where we're just picking a short-term top or bottom. I'll show you an example momentarily. Let's continue. So I want to buy a put. What the heck put do I buy, Dan? And what the heck is, what is it? Well, I already defined a put. And so what's missing there? So we're going to buy as just, I have a detailed seminar, obviously, on selling options and buying options. And, Greg and I pride ourselves in giving you as much power-packed information in these sections as possible. Other people they're just sitting there giving you a sales thing the whole time. And so I can't give you an 8-hour course in 45 minutes, but I'm going to do the best I can. So IWM closed at 156. So what put do I buy, Dan? Well, remember we said I'm going to buy a put, and it gives me the right to sell this underlying ETF at 159 strike price on or before expiration. So as this IWM falls, as I hope it will per our bias, then this put option that I'm going to buy right now, I'm showing you which one I'm buying on this screen, is going to go up in value. Just general rule. I don't have time to get into everything. I like to buy in the money puts as a swing trade, roughly 80, 85 delta. I don't have time to get into it now. My apologies. So we're going to pay $3.08 a share for this right to participate in my swing. One contract represents 100 shares. Remember, I have a small account, $5,000. So I'm going to buy one put option. But these are, you can only buy one. So you got to multiply it times 100. So one contract is going to cost me $308 in my $5,000 account.
That's reasonable.
It's because, Greg, if I were to buy 100 shares of 150, just round it to 156, even with 2-to-1 margin, this would be $15,600 divided by 2-to-1. So divide that by 2. And that's what it would cost to short this in your account. So we have leverage and limited risk. My max gain is if IWM went to 0, which is not going to happen. So I don't even care about answering that. My max loss is what I paid for it. $308. That's my max loss. I'm never in, Greg, I could hear somebody thinking, well, Dan, if I hit my max loss of 308 in a $5,000 account, that's a pretty big hit. Well, number one, yes, it would be. Number two, we never come near our max loss because of our stop loss on the pattern.
Good.
So I'm going to show you this on another slide where we sold them in 3 days. So we made 130% return on our one contract. Okay. So, here's the chart. 3 days later, we trail stopped over prior bar's high. We sell our put. We're managing them identical to as if I were short the IWM. Again, quick and dirty here. I mean, what's the best strike? I mean, some people might say, well, Dan, why did you pay $308 when I can pay $100 on this other strike? Well, they have different reward to risk profiles because they're going to move differently based on how much in the money they are. Again, I apologize.
No, don't apologize, Dan. I'll
but it's
explain, make it simple.
all right.
Look, where they moved some drawing things around here. You know, I love my little drawing thing. Here it is. Okay, so we got a chart that's going up. In this case, the IWM was making a little double top, and it was going down. Now, I always look at everything in the most simplest way possible. Makes it easy to digest things and think about what you should do. So if IWM, let's say, is trading here, let's just call that $10.
Okay.
And we think it's going to go down. Well, if I buy an option that is at about close to that strike, right? We're saying whatever it is, that's the option strike, is close to that. And option traders have terminology for that to say delta down, right? The delta, right? It's close to whatever 80 delta or whatever.
Right.
So they have these numbers that they look at rather than just say, because they don't look at a chart and say, hey, IWM is trading at $10. So if I buy an option that the strike is at $10 or whatever the cost is, it's going to move close to what the underlying is, IWM.
Right.
And if I buy something that is in the money, right, well, it's going to move a little closer to that. Forget the details of it.
Right.
But if I buy an option with a $5 strike, well, IWM could come down a whole bunch. And because of it took 5 days and my option is going to expire in 5 days, maybe I made no money. So
right.
you can't say, and this is the trap so many new option traders fall into. It's like, hey, I think it's going down. I'm not paying $3. I'm going to pay 50 cents, because 50 cents, if it goes down there, you know, the big if word, I'm going to make a fortune. Well, you've got this other, what's the term I'm looking for, Dan? This thing that, options have these different variables, time, volatility, and
Time decay. Sure.
yeah. So, I mean, there's different names for that, decay versus time, and
Yeah, right here.
they whatever. And so what you want most option traders find out is that because of time decay or a lack of momentum, maybe it got close to their strike, they lose money, or they made very little. So a quick dirty thing is to buy something close to what they called at the money, give or take.
And in the money too, right?
Right. So say it's $10 and you bought one for $11, or
Right.
you bought one for $9, and
Exactly right. You
you're
want
going to be close.
exactly right. All right. So this is, I'm showing you just a different strategy. Instead of buying the put option alone, we're going to do 2 transactions. We're going to buy the same put option that I just did on the other screen, but we're going to then sell a lower put option. And that's what's called a bear put debit spread. So what that does, and this is a great strategy on a small account, because instead of, Greg, the cost being $308, remember, we are now reducing the cost of this one contract to $161. We like almost cut it in half. Now that, just textbook answer, that's going to increase the probability of profit. And the only downside is we are capping our gains. That's okay. Don't be a pig on Wall Street. We're increasing our probability of profit. We're reducing the cost. We're reducing our max loss. And that's a great strategy for a small account. So our boy Tom Cruise here. So here's where we stopped out of the trade over a prior bars high. You can, go back and look at this on your own and compare the numbers here, but we have to move on. So had I just had a long put alone, I would have made a lot of money. I still made money. I still made beautiful money here on my put spread, but I capped my gains. Now I told you I was going to show you the same directional setup. This is what we call an income strategy, which is also a great strategy in a small account if done intelligently. So Greg, I love asking you this question. When this trades triggers under this bear 1, 2, 3, we're show them 160. Remember I said, folks, people buy call options because they think it's going higher and they don't use charts. And we're like, once this triggers, that ain't going back up to 160 in 4 days, because this was a 4 DTE. And we buy a further out of the money call just to lower our risk and the amount of money the broker is going to hold to put on this position. And I'm going to show you, I have a slide on how to calculate share size in a small account. But in this example, we shorted 2 contracts in a small account. And that brought us in $96. So I have a $5,000 account. I got multiple trades going on. And as long as this doesn't go over here, Greg and viewers, in 4 days, my account just went up $96.
Zoom changed a whole bunch of stuff around, so I'm trying to do stuff to explain stuff.
Oh,
So what Dan, so to understand what we're doing here with a spread, if you don't, is that this 160 and this 165, you are selling one and buying another, and where I put the diamond is the 48 cents that goes into your account. That's going to expire. These options are going to expire in 4 days.
Okay.
So the prior example was, hey, this is a directional strategy, and it went down and you made very nice money. Whereas this one here is like, look, I don't care if it goes down. If it goes down, great. But if it goes sideways, I'm going to make my money because this thing's going to expire. And that's the idea of what's called the melting ice cube, the time decay. So it depends on how bullish or bearish you are, or just a way of saying, hey, you know what, I kind of prefer, this other strategy here and put this 48 cents in my account. And as long as it doesn't go up here, I get to keep the money. So it's kind of, what vehicle do you like better versus, really should look at it as like, okay, I look at this pattern and what is the higher probability of something going up, down, or sideways. And that is where you really have to learn the patterns. But if something had, for example, had a whole big giant, let's just say, drawing thing here. I move stuff around. In Zoom, this is like a new thing that they did.
I know, I saw it too.
Say this bar here is a big, ugly, nasty red bar. And now the credit spread again is up here. And it's like, oh, and there was only 2 days to expiration. And you're saying, well, it's down here. What's the probability of it going up there in 2 days? I was like, well, that's a no-brainer. And you say, well, what about if it goes down? And I was like, well, it moved a whole heck of a lot. I'm not sure if it'll go down in 2 days, but I'm really confident it's not going up in 2 days.
Okay.
So the chart really is a phenomenal tool for, if you understand how to read it, as to what the probabilities are. So one of our favorite things to scan for is wide range bars. The big, powerful bars. There was a big event that, institutions had to be part of. And what I drew here is it gapped up and it collapsed. And so think about what's the probability of recovery from that bar in a short amount of time. Common sense says it's low.
But you see, Greg, what's emanating from that comment of yours is the reasons we're so successful as option trading is because we start with a technical bias.
And again, I see people that can do options profitably without that. But, most of them, which you've pointed out to me, they say, well, some say you can't do it short term. And others say, well, why are they going out 30 and 40 days? And their reasoning is to give it time to work. Well, if you look at the freaking chart, you see what the probability is for it to work in a short amount of time, but they refuse to do that.
Right. And so ROC is return of capital, and I just put this here to show you, look, we made a return on our capital because the brokerage firm is going to withhold the spread with less credit received. But even though the stock fell and we made our money in selling options, whenever you tie up capital, I want to get paid for tying up my capital. And here's how you calculate it: 10%, and the stock didn't even have to fall. All right, we'll go through as many examples as we can. We've been very active recently. Now, I personally always trade options if they are liquid. That is so important, folks. And again, you see, we always have to start with a bias on the charts. So this Carvana here, I'm going to show you two trades. One was a directional and one was a put spread. So we spent a lot of time on that hypo. Let's go a little bit quicker now. And we have hundreds of examples, so it's just a time limitation. So Greg, our daily charts here are always this clean and simple. Color-coded candlesticks, volume. We show the 20, the 50 is the green, and the red I'm kind of hiding here is the 200. It's pulled back to the 50, and it's red, green, red, green, red, green, but it's not going down anymore. So now, Greg, we have a closing breakout. This is, you and I have this name we call a bear sandwich. We have a price void, meaning look to the left. And could we have bought just a call option? Yes, of course we could have. But remember, we covered when we do a debit spread. So we're buying one call, selling a further out of the money call. It lowers our cost basis. So again, we have a $5,000 account, okay? So if we buy one contract, it's going to always just add 2 zeros because these are quoted in per share. So I'm spending $250 in my account. I'm buying one contract. This is a closed trade. We keep all our open and closed trades in the members area for subscribers. And we bought a $40 call. We sold a further out of the money call, lowered our cost basis. We give the technical setup, a bullish 180 reversal breakout at the 20 and 50 period moving average. We give trade management along the way. If you had multiple contracts, sell half here, sell the other half here. And we made 52% return on capital in 2 days.
So everybody understands. I don't know if you made that clear, Dan, because before we were talking about putting money in the account to credit. This one the money's being taken out of our account, meaning we're doing an option trade that this is called a debit. So we're paying, but we believe something's going to happen. In this case, the stock's going to go up. So we could have done, if there was available, you've got to look at the option table. If there was a credit available, say something down here, we could have done a credit spread.
Next
But
slide.
this is directional, it can come down to an obvious place where buyers are going to show up. We utilize a tool or concept that we created, bar by bar analysis, and we believe that this is going to go up. And we could have just bought a call, but we're funding the trade. We're limiting our upside with this debit spread. So as long we believe it's going to go up, and it's got to go up for us to make money, versus the credit spread where it could just go sideways and we're going to make money. But you got to decide what vehicle you're going to use and why. And that's what we're explaining here.
Well, and Greg, we are doing it on both. 1 second on the next slide. So remember, whenever we buy something, that's our max loss. So we risked $250 on one contract. This is a closed trade. 2 days later, we made $260 on one contract. So this is intelligent. This isn't, oh, come to my casino and I'm going to show you how to make 100% on your option trades. No, this is a no-brainer setup, and we did it intelligently, and we just went into trail mode. All right, so actually, let me skip through this. We'll go right to this one. We've talked a little bit about selling these put spreads, but this is just another beautiful slide to show it differently with these red and green candlesticks. So these are all bullish terms. Okay. We're going to sell a put spread under support. That would be called a naked put if we stopped right there. But particularly in a small account, I want you to be limited to these credit spreads. So you're going to buy a further out of the money put. It's going to lower the credit to your account, but it's going to be less buying power and less risk. And that's exactly what we want, particularly in a small account. So Greg, you wanted to talk about this Carvana put spread, so take it away.
Yeah.
Same shirt.
So when you said, Dan, we're going to be buying this put, sometimes maybe I didn't hear, but what you're doing, you're funding the buy with the money from what you sold.
Partially, right.
Partially. So that's why you get the credit. So what this is saying here, selling puts under support, meaning, well, I look at this pattern. What's the pattern? Wash and repeat. It's been a strong stock. It pulls back to this moving average. I see the price action. We call red bars ignored, meaning it looked like it was going to go down and now it doesn't. It retraced 100% of the red bar, and it did it 2 times. Reinforces my confidence that it's not going to go down. I believe it's going to go up, but I'm pretty sure at this point it's not going to go down. So if I sell a put, right, what's a put? It's a bearish bet. Someone thinks it's going to go down. Someone's on the other side of the trade. Somebody thinks it's going to go down. I don't think it's going to go down. So I sell the put. And then I go and buy. If I'm going to do a credit, I go and buy another one. And the difference is what I get. And I believe that this guy is going to lose all his money.
Well, the guy that bought it, not sell them, but
Right. So look, you have to boil everything down to understanding what we're doing here. Meaning, if you're caught up in thinking, Ichikumi clouds and all of that hocus pocus stuff, no, what we're doing here is we're creating a belief our thought process, right? Everybody that's trading has a belief, whether, hey, the PE ratio is low and whatever, or sales to put ratio, or hey, it's your Kumi clouds. How are you coming to your belief that something's going to go up, down, or sideways? And what we're explaining to you looking at these charts is how we come to our beliefs. Now, how are you going to profit from that belief? And because that belief could be a mistake, maybe wrong for whatever reason, things happen. How do we limit our risk? And so what we're talking about here are different ways of limiting risk and how you can still make money with a small account and doing it intelligently.
Yep. Folks, we have a no-brainer $7 trial to our live green trading room. We start at 9 a.m., go till after market close, and you watch, you interact with Greg and me in real time. So we say here, experience what we're talking about during market hours. We're scanning, we're looking at the market, we're trading stocks and options together. We're answering questions. It's a fantastic place to get to know us. So, when Greg saw how many slides were here, he's like, what are you, crazy, Gibby? We're not going to get through this. And I'm like, I know
that.
I'm like, relax. And because look, I did this for Sam. I don't know if Sam's in here right now. Sam is a marvelous trader in our green room, and he allows me to make fun of him. So I did this after you, Sam. Set up, analyze, manage. Okay, so I'm going to go through these so fast because it's wash and repeat. But I just want to show you here, folks, how we do this over and over and over again, provided they are liquid. I can't overemphasize that enough. So here's a breakdown. We bought puts for $1.15. So depending on how much you want your risk per trade, you might do 2 contracts of this one, risking $230. Made 82% in 2 days. Wash and repeat, climactic buy setup, analyze, manage. 81%, $262, just buying $70 call options for a bounce. Wash
So,
and
yeah, let me add, I know you're going through here, but I'm explaining the posts that these are posted into your text, and they're in the member area where you could read. And look, even if you don't know what this means, climactic buy setup and bullish reversal, because you haven't taken a course with us, that isn't even necessary. All you need to understand is this basic stuff to understand what's a credit spread, what's a debit spread, which is education, of course. Everything comes down to education. But as far as the setup goes, it's good to understand why we're doing something. So as you progress with Master Trader, hearing certain words communicates to you, hey, what's a climactic buy setup? Oh, that means it fell a whole heck of a lot and it's reversing. It's probably not going to go down a lot more, and it might go up. Then I understand this trading vehicle called a credit spread or a debit spread and a put and a call. It's like and then it's explained. How are we going to profit on this technical setup? And that is what is explained in this post that comes to you, so that you understand the what and the why and the when.
I like that. What, why, when? Breakdown here, we paid $290, made over 100% return. Very simple management. We just trailed. Here's another one, a bear 1, 2, 3. We paid $180 for 1 contract. When I took this screenshot, we were still in it actually. But you can see here, we sold a third for here and $290. It's, we just manage in between the setup, analyze, manage.
And those check marks are just somebody saying, what's a 1, 2, 3? A big bar, it's a little bar, and a continuation bar. So our terminology, you have to get used to it, but it comes quick. And in the member area under resources, there's slide there, a post that gives you all the acronyms.
Yeah.
Yeah, plus or minus 1, 2, 3. Exactly, Robert. Thank you.
Yeah, I mean, just here, let's just look at the return here. 2 days made $360. 9 days, 360, just drifted lower. 60% return. That was another 1, 2, 3. Bullish 1, 2, 3. 109% return. This one only cost us $215 for one contract. Greg, you have the saying, same but different, and this is it. 2 days, $320 on one contract.
So,
Same.
yeah, you're saying same but different. Of course it is. Is it going up, down, or sideways? Is there a pattern? And so, while we have a few names for patterns like 1, 2, 3s or bull or bear sandwiches or climactics, they're shorthands. There aren't a lot of them. But when you start getting into all these candlestick names, which, I mean, there are like 50 or 60 different candlestick name patterns, it becomes overwhelming. But as you learn, especially the concept of bar by bar analysis and an easy way of telling, is it going up, down, or sideways? It's like, hey, look at those moving averages. They're facing up. Okay, 2 moving averages going up. That means the trend is up. Now you see, we haven't talked about pivots, but these little dots show us where support and resistance is being created. And at some point, we get a pattern and say, like, there's the wide range bar. I say that's one of our favorite scans, to find wide range bars. So the wide range bar happening in an uptrend in an area of support suggests it's going to go up. How do I make money if it's going to go up? Buy a call, buy the stock, do a debit spread.
There you go. And manage in between.
And you could do a credit spread, because if there's premium there, probably not on a $20 stock, but everything eventually comes down to it simple once you understand it. And that's the reality. In the beginning, nothing is so simple. Simpler, but simpler than trying to understand, Vega, Thea, and all of that stuff.
All right. So folks, if this interests you, both for selling options, credit spreads, and buying options, the way we just discussed today, mastertrader.com/spread trader. You can read about them in very detailed description on the website there. And this is a special Greg came up with a week ago. We just extended it here. We're going to give you 2 months for the price of one of the swing and options trade letter, where you get trades just like this with the setup, the date, the strategy, the technical setup, management in between. Plus, we have these 2 free educational seminars for you. Some flag patterns, 1, 2, 3 continuations. We showed you a couple of them in here. And that's it. Let's take a look at real charts here in the remaining 10 minutes. And I typed earlier on that call spread, MRK. We did a call spread on that today. And Greg just gave you the link for the checkout for this special. Sure, Robert. Yeah, we save time here to look at anything you want.
Where's this? Just looking for something, you could just read generally about those that are new, master trader education.
Here, I'll find it.
There, I got it. So you want to look at ARM, which is a new issue. I've been watching it to see if it can lift off of this little retest pattern, which it hasn't been able to do yet.
But Greg, you and I are both thinking if it can trade above today's red bar, it could go all the way to that big gap, unfilled gap. Because
Right.
that would be a shock pattern if it could take out today's high.
Right. So, it's retesting this high area here. It retested this low area and buyers stepped up and, now it's in a little trading range indecision, but it's at the top of the range. And if we could get a reversal bar here tomorrow, I suggest it's going to go up. That's what we call a bullish 180 and a resistance area. And at that point, buy the stock, debit spread, check it out. So options are here. We could look and see how many days to expiration. Oh, look at this, Dan, 37 days. This doesn't have weeklies.
Let me look on mine.
Not that way.
No, it does. Mine show it. I don't know why yours doesn't. Doc, yeah, you're in the green room, so but yeah, we look at possible options trades on earning stocks every single afternoon. We look at ones not expiring, reporting earnings after the close or in the morning. And we're do what we've been talking about today. We might buy an option as a speculative earnings trade, or we might sell options based on a beautiful pattern, and we're willing to take the risk. For example, as Greg's playing with that, JB Hunt has earnings next week, but it's a put spread candidate into earnings because it's a beautiful bottoming pattern on the daily and weekly.
All right, so that's a pattern that we would look at. So it's kind of messy here. I'm not so sure if it would go up, but you can see the wide range bar and this wide range bar, and it's retesting on the 200 MA.
So the 180s are lower is what we would be looking to see what we can get paid for taking that earnings risk.
This date shows when the earnings are, which is on the 17th. Well, it's next week. All right. What else are we gonna look at?
I mean, the markets are weak. Show them that the Merck, and you were looking at J&J.
Yeah, that was part of our discussion yesterday.
Yeah.
Someone in the room brought up Merck, and I said, "Well, take a look at J&J. That's in a downtrend. It's at the 20, and there's some resistance there. It should go down."
So let's apply what we've learned today. So we would be looking to buy an in the money put for a directional trade, and then go through our checklist to see what premium we could take in for and selling it out of the money call credit spread. And we did the call credit spread on this. So Greg, show them 105, 107 on Merck here with a horizontal line. So here's the trade we did today, folks. This sell set up in reversal. We sold the 105, bought the 107, and we took in 48 cents a share into our brokerage account. So if you have a small account, you could do 2 contracts, take in $98 and stop out. In this case, we just gave 105 as the stop loss.
105. So everybody can see, here's 105 and here's 107. And so a call credit spread, you get the difference between the two. Brian's asking me if the 50 moves up past the 20. The 50 is moving up past the 20 would mean it's been in a downtrend. 50 moving up past the 20. Is it bearish? You're saying, is it bearish? I mean, here you see the two moving averages pointing down. So the 20 crossing down below the 50, prices have to be going down. A longer term moving average moves slower than a shorter term moving average. If this starts to go up, the 20 at some point has to begin to follow. These are simple moving averages, which means every time there's a new bar, it drops off what happened 20 days ago. The 50 drops off what happened 50 days ago. So there's a lag, which is what you want. If you put on a 5-period moving average, it's going to be closer. So there's no right or wrong to it. Like if you go to and trade a 2-minute time frame, things are going to move a lot faster than on a 15-minute time frame. So what do you want it to do? You don't even need the moving averages, right? They're what we call visual aids. So as I look at a picture and I see an alignment of moving averages like that, well, it just jumps out at me. This is a weak stock. That doesn't mean it can't go higher. Will it go lower? So the example here is that it came up to what we call minor resistance. There's some resistance area here. It's in alignment with a moving average, and it begins to roll over. So we believe it's going to go down. We believe it's not going to go up a lot. I mean, this is relatively close, but in a short-term credit spread, it's all about the time. Is it likely not to go up in 2 days? Or what about in 30 days? I don't know what's going to happen in 30 days. So you got to pick that time to expiration. All right. No one's got any questions as to what we want to look at today, but
Well, I was asking about the spiders where we don't have a lot of time here, but
that's all right. So the markets are correcting. You can see 5-minute charts. Spiders are grinding down. The Russell is weaker. And if we look at the daily time frames, we discussed this pre-market. Go and look at the pre-market review. Said odds are today is going to be a turn day, and it's likely to be choppy because turn days are choppy. That's what we got so far. There's a big news day tomorrow, economic news. So, things can jiggle around, but the alignment of where things are here, there's going to be sellers in this area. It's just the way it is. You look to the left. It's at an area of resistance, and sellers are showing up here. And this is where there's going to be a battle between buyers and sellers because it came off of the low, nice and strong. Tech was leading. Look at the big wide range bar over there. And so now it's going to back and forth jiggle around, and we're going to see what's going to transpire. Well, today's probably not going to do a whole heck of a lot, but when that news comes out tomorrow, odds are that things are going to be jumping around, but the upside should be limited. And just because of the arrangement here. Now, you could trade options on this. These are super liquid. And right now it's just choppy, so I wouldn't be doing anything. But as you can see, these options here, if you wanted to even day trade these, if you could read the chart accurately, you could do it.
great instrument for day trading. All the liquid ones, Facebook, Apple,
Yeah.
Cisco.
And I'm surprised more people in the green room don't do it. But certainly can. So you got to check that out. And just looking at it's like everything else, we look at multiple time frames. So prices are extended here. They're up against this resistance area. Common sense says it's not going to go up a whole heck of a lot right now, especially with news pending, but it's been strong. So these don't have the super high premium to do credit spreads like the S&P 500 SPX does. But this morning when I did pre-market, I said the SPX the call spread was going to be the highest probability trade versus the put spread because of the location of where things were. And now they're starting to buy a lot of 4,400 calls, which are going to expire Friday. But as of today, it's just highly unlikely that it's going to go there. So, one of the things to look at is, looking at this open interest over the, how many days here, you got to sort it by how many days. And then I don't know if it'll stay there. Anyway, if you come into the green room, Dan and I are educating every day. Some days, where it's boring, maybe we do more education and more small talk, but there's always, trade ideas, always education, and, everybody should want to learn a lot along the way of, finding out how to do it yourself. So with that being said, you can sign up for next Wednesday. We'll be talking about, what are we talking about next Wednesday, Dan? I had it posted there.
It's the traps.
The traps. Yeah. Let me just post this here. And if you want to sign up for it,
Thank you
you
for
can do that.
listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.